Tax-deferred real estate. Okay, now this is maybe surprising to a lot of people, but you can self-direct your IRA and buy property. There are no penalties for doing this. It's different than the idea of borrowing from your 401k. It's not that. It's not taking money out of your IRA. Instead, you can actually have your IRA buy property, invest in property, but you probably can't do it where it is right now. You can't do it with your Schwab account. You can't do it when you're just have a normal IRA. So you have to self-direct your IRA. That depends on the IRA custodian, but a few $100s to self-direct your IRA, and then you can direct it to buy real estate. Let's say that you did that and the property increased in value at 10%. No, I'm sorry. Let's say that all the rental income from that property brought in cash flow every year of a 10% return. And let's say that in addition to that, after 15 years, the property is doubled in value, again, at a 5% growth, which has been the way it's been since the 60s. So there's a good chance that could happen. And then let's say you went and sold it. So now you've made all this cash flow that's gone back into your IRA. The property's now worth $200,000. You sell it. You don't have to pay the taxes or the gain on that because it just goes right back into your IRA. So this is, again, a wonderful way to defer those taxes and build a retirement portfolio. Passive income. This is another reason why I love real estate as an investment. You can earn income from it whether you're working or not because it's an asset. It's something that somebody needs and will pay you to use. So when you buy a good house in a good working neighborhood and somebody wants to live in it, they're going to pay you every month to live in it. That's passive income. So really, cash flow is the number one best reason to own property today because you can count on it, that cash flow coming in month after month after month. And the wonderful thing about buying today is that prices are still down and mortgage payments are low. So that combination means that you can get a really low monthly payment, but still have high rental income. And the difference is the cash flow you put in your pocket. So it's just a great combination, not one that we've seen in a long time, getting this kind of cash flow. I know when I was buying properties, we were just happy to break even, because prices were high and interest rates were high. But the opposite is true today. But that window is changing. I mean, we're seeing prices go up and mortgage rates go up. So it's not going to be this good forever for sure. But what we are seeing is that rents are holding steady. We don't know if they're going to continue to go up, although historically they have, but we're not seeing them go down unless you're buying property in areas that are 100% rental. So we've seen that in parts of Arizona where so many investors have gone in between hedge funds and foreign investors and domestic investors buying property, renting it out. There's a lot of competition for those rents. So we're seeing in some areas those rents going down. But in other areas where there's the fundamentals in place that we like, the job growth, the population growth, the affordability, we're seeing rents holding steady or going up. And those rent ratios, like I said, are the best we've seen in a year, 1 to 2% of purchase price. So let me give you an example. If you're going to buy that $100,000 home, you should be getting $1,000 a month in rent. Why do we not buy in places like California? Because it's hard to get that rent ratio. It's not going to be that good. Now, there's some places where I'm buying where I can buy a $50,000 home in a very good neighborhood and rent it for $1,000. That's a 2% rent ratio and is just unheard of. I don't know where else you're going to get that kind of return. I don't know how long it's going to last, but believe me, I'm personally buying as many of these as I can. Okay. Another reason I love real estate as an investment is that you're in control. So what this means is no asset manager is skimming the profits except you. And let me just say quickly, I always found this very interesting that when you use a financial planner and you have your money invested and the stock market tanks and you lose money, I find it interesting that the asset manager still gets paid, even though there's losses. And nobody sort of blinks at that. It just has become the norm. And and we've been taught by our financial planners in the stock market, that is going to go up and down. So you should expect it to, and therefore, that's just the way it is. Well, I don't want to buy into that I need to pay somebody in spite of me making a gain or a loss. I don't like that. So in real estate, there's nobody skimming profits except you. It's tangible. You can see it, touch it, drive by it, and walk through it. Whereas a lot of investments that we put our money in, we don't know what it is. We haven't driven by it. We've not been to the offices. We haven't looked at the financials. It's just pure faith. So it's a little different with real estate. You're the one who can order the inspection. You can order the appraisal. You walk it. You learn it. You meet the people that are working on your property. Again, you can verify through inspections, appraisals, title reports, and tax records. And you can understand it. It's not just a pile of paperwork that is written so that you won't understand. And then asset protection. This is another thing I love about real estate as an investment. You can hide your identity. So first of all, you can get liability insurance on each property. I don't think you can get that on other investments. But sure, if something breaks or someone gets hurt on your property, you have liability insurance to take care of that. The same with umbrella insurance. You can get an umbrella policy on your primary residence that covers your rental properties. If you have a lot of rentals, you'll need to get a commercial umbrella policy to cover it. Still very, very inexpensive and can cover, $2 to $5 million worth of liability. And I just can't imagine there'd be much more liability than that. I mean, if there's a slip and fall or a fire, someone gets hurt, I don't imagine that the liability will be over $5 million. So you can have coverage against that. Equity stripping. Now, I just did a segment on Fox News about this, and it was very controversial, so I'll try to explain it here. But what equity stripping is basically if you own a home free and clear in your name, you would not believe how easy it is to do a title search and find it. So basically, Kathy Fettke, look in California title reports, you'll be able to pull it up and see, oh, she owns a property in Lafayette that's worth $1 million. That's $1 million that's just kind of sitting there exposed. So if somebody wanted to earn that $1 million, earn in quotations, they could come to my property and accidentally slip and fall and sue me and get at that equity because, they can find it. Or let's say somebody wanted to sue me for something else and their attorney could do a very quick title search to see what I own. They can sue me and take that equity. So we call this equity stripping, where you actually take a loan out on your property or an equity line. And then when someone does a title search, what will come up is, the property is worth $1 million, but she has an $800,000 loan on it. There's no equity there, nothing to take, not as interesting. Now you can take that $800,000, and again, let's say I'm talking about your primary residence, and you could buy 8 $100,000 properties elsewhere, let's say in Dallas or Atlanta or Pittsburgh or some of these areas that have really great cash flow. Now you have your equity spread out, it's diversified. You can put all of those rental properties into an LLC so that, here it is, a limited liability company, so that it's very difficult to find what you own and where you own it. So now you've diversified. People don't see this big bucket of money all in one place that they can go after. And you've got all this rental income coming in that helps to pay off that $800,000 loan. Because as I said, remember we have the 1% that we're looking for, which is, $100,000 property should bring in $1,000. Well, if you bought 8 of them, that's $8,000 income. So that's more than enough. Of course, there's going to be expenses and so forth, but that's more than enough to put towards the mortgage. That might be an $800,000 mortgage. That mortgage payment at 5% is going to be, around $4,000. So again, you have more than enough money to pay it, and you've got some asset protection. All right, on to inflation. Real estate is known as a hedge against inflation. All right, let's look at this closer. A $100,000 home and an $80,000 mortgage at 4% inflation. I think we're much higher than that, but let's just use that number. That means that each year of inflation, $3,200 of debt is just eaten away just merely by inflation. Now, why does the government want to create inflation? The Federal Reserve has stated that it wants to create inflation. That's its stated goal. Now, why? You don't want it. I don't want it. I don't want to go pay more for goods. Why would we want to be creating inflation? I will tell you why. Because it eats away debt. Who's got a lot of debt? The U.S. government, right? Okay, so when the government is inflating by creating all this money to help pay off the debt and create inflation to wipe that debt away, we're going to lose at that game because, again, would you rather the inflation beast eat your debt or your cash? So if you have a bunch of cash sitting around or a bunch of home equity, the same thing happens to it that happens to debt. It gets eaten up. So that is one of the reasons why real estate is a wonderful hedge against inflation when you've leveraged it, when you have loans on it. There is a difference between good debt and bad debt. Good debt is the kind of debt that buys you assets that make you money. Bad debt is like credit card debt where you went out and bought things that you couldn't afford otherwise. I'm not suggesting that kind of debt, but I am suggesting good debt that gets eaten away each year to inflation and allows you to buy these assets that grow in value with inflation. It's a total win-win. All right, look at this slide. This is kind of depressing. No, this is super depressing. This only goes up to 2009, but imagine what it would be today. I mean, it's just going to keep going down because of this radical money printing that has happened. So again, the red line is currency in circulation. That's all this money printing. And you can see, when did that start? 1971. What did I say about that? Nixon took us off the gold standard, and all of a sudden, no one was watching the bank. They just print money. No one cares how much. So that created all this currency in circulation, which then devalued the dollar. It gives you less purchasing power every year. Again, let's go back to that slide. The U.S. went off the gold standard again, 1971. Look at the money creation that happened afterwards. Unbelievable. We are in uncharted territory, people. We have not had our government go crazy like this ever. So we don't know what the consequences will be. But the only thing I know to do is to play their game because we can't really fight the U.S. government at this point. Hyperinflation. Is it coming? Is it not? Some people say no. Some people say yes. I don't know. I'm not an economist, but I can tell you this. Casey Research is someone I follow. It's a group I follow. They came out with this in 2010. Look at that. Year over year, change in pricing for wheat, 74%. Oats, 68%. Pork, maybe you shouldn't eat it, 60%. Cotton, 66%. Gold, silver, now that's gone down, so let's not look at that. But how can you say that we're not already having inflation? We are. And yet, look at this. Look what the government reported in the CPI index. 1%. Huh? Where do they come up with these numbers? I don't know. All right, but what I do know is that assets inflate when the dollar deflates. It's just the way it is. That's why people are running to gold. Even though gold is not the best investment, which we've seen lately, but people were running to gold because they knew that the dollar was deflating. The problem is gold isn't that useful. Housing is. Gold doesn't pay you monthly for using it. Housing does. So, in my opinion, gold is a major risk, again, which we've seen. But look at this. Look at the increase in median single-family home prices since 1971. And look at the dollar devaluation since 1971 and the red line there, which is the currency in circulation. See how that red line is right in line with the home price increases? So again, the more money that is in circulation that the government's creating out of thin air, the effect is higher home prices, higher asset prices, higher prices in real estate. We're going to keep seeing that trend.